Hello, everyone. We are back with our second edition of the Analyst Corner. I'm Nirmala Balakrishnan, practice lead at nasscom Insights, and will be your host today. The announcements of the Q1FY2024 financial results of the listed tech companies are just around the corner. We thought this is the right time to talk to analysts who are tracking the industry growth and learn from them what they foresee in the Q1 results and also the analysis and outlook for the next year. Today, I have with me Abhishek Shindadkar, Associate Director, InCred Research Services. Abhishek has over 17 years of experience in the tech industry as a tech industry analyst, and is a pro in tracking the sector. Thank you, Abhishek, for taking time out to talk to NASCOM, and welcome to this session.
Thank you, Nirmala, for giving us the opportunity and to speak on along with NASCOM.
You so much. So I'll quickly jump into the questions, Abhishek. So we know that the macro headwinds in the key industry verticals and geographies continue to remain, along with the geopolitical turn. So as a first question, I would like to understand that along with positive and negative demand indicators for the technology sector for this quarter, and say in the next 6 to 10 months, what do you see? What is your when you talk to the other analysts and the key leaders, what is it that they're talking about in terms of the demand scenario?
From a vertical standpoint, if we dissect the demand trends right now, financial services and high tech are, two verticals where we continue to see some moderation. In the financial services space, capital constraints and the rising interest rates are the key drivers of this moderation, while in the high-tech space, the value chain is impacted by excess supply, inventory correction, and demand softness in the entire computing or computer landscape. On the manufacturing side, there is some traction, primarily coming from Europe, and this is led by auto, trucks, off highway. Aero is one vertical where we are hearing that the design cycle related spends could start in the next 12 months. So manufacturing is a positive that we are hearing. Retail CPG, there are not clear tailwinds or headwinds from a demand standpoint. It is a little sporadic based on individual companies. So that's what is the summary at the moment. Probably 6 to 12 months hence. The demand right now is characterized or what's happening is that we are coming from 2 good years of spend. The digital transformation related spends, we are seeing some moderation, and the large deals, especially on the efficiency, are in the market. If some of them convert, then we could see some acceleration in the demand from versus what we are seeing currently.
So we are seeing Europe as one of the regions which can pick up, and earlier we always had USA, or the North America is supposed to be our greatest market, and now you're seeing some traction that could pick up in Europe also, right?
Yes.
So, going into my next question, so have you done any kind of analysis of what is your expectation for this quarter in terms of revenue and margin growth? And we know that tech companies specifically, are have taken a lot of measures to stabilize their margin growth. So, any insights around that, and also how is the cross currency headwinds going to impact this growth?
So from a quarterly perspective, we expect tier one companies growth to be, flattish on a quarter-on-quarter basis. On a year-on-year basis, we could be in that mid single digits on a YOY basis. For tier twos, from a quarter perspective, the average growth could be somewhere in that, 1.5% to 2%, or let's say 1 to 2%. And the year-on-year reported growth could be in the 10 to 12% kind of a range. From a cross currency perspective, this quarter, we estimate that there could be a tailwind of roughly around 25-30 basis points for our coverage universe at an average.
And similarly, in terms of headcount and attrition, so we have seen in the last few quarters there has been a dip in the employee addition among the top players, and which is mostly in line with your hiring correction, which is being undertaken by the companies. We have also seen attrition levels stabilizing since the last few quarters, though it is still at a higher side. So, what is your assessment in terms of both these metrics? Again, if you have any insights around the quarter and for the full year.
So if you see, the recent Accenture earnings as well, what Accenture, saw a net headcount reduction on a QOQ basis. And what their commentary is suggesting is that it could continue in their fourth quarter of the fiscal year, for them. Now, this is driven by, automation and reskilling. So, our view is that Indian IT companies have also been focusing on, the pyramid correction, optimization of bench, so on and so forth. And so similarly, given that, hiring has moderated substantially, and the attrition continues with the usual, rates, we believe that some of the Indian vendors could also see a reduction in their net headcount. And as a trend, I think attrition, given that, the demand has also moderated and which is, kind of correlating with or kind of driving a moderation in the hiring. On a net basis, we would definitely think that throughout the year, the hiring could moderate substantially, which also means that, the net addition could also be very subdued throughout the year.
Yeah, and exactly like I said, that's what we have been seeing in the last few quarters also. Though in FY22, we had a very, very high hiring and the net hiring was very high, but that's been stabilizing. I think it's a correction that's going.
Yeah.
Great. So I'll quickly ask you about the deals. So we have seen that, again, in the past few quarters, cost optimization related deals picking up. So any analysis or insights around that, how these deals are panning out? Is it moving faster in terms of decision making? And also, is there, what are the size of deals that you see picking up? You already said that demand is right now moderating. So are these deals going to be small sized or moving to large transformational deals? And is there anything that you can give a color?
So, so from a perspective of deals, our assessment has been that, decision making definitely is elongated. Clients are procrastinating, are trying to procrastinate as much because, the risk clauses, the mitigation clauses, the rising inflation together has made contracting a little complex compared to what it was, immediately post-COVID. So net, the decision cycles are longer. Smaller deals are fewer in the market. The kind of traction we saw in smaller deals post-COVID is not being seen currently. What is there in the market right now is very large transformational deals which involve cost optimization, as you rightly pointed out, and the constructs of those deals generally take longer time frames. That is also kind of driving the slowness in closures. So I think, we would continue to see longer deals in the market. Some of the deals in Europe have been in pipeline for almost, a couple of quarters now, and could convert given that, decisions may be finally taken on it, driven by efficiency and, lack of available talent in those markets. So that could kind of positively surprise the deal closure momentum in 24, barring the usual weakness that we all are aware of.
You already spoke about some of the verticals that can, accelerate or be an opportunity for the IT players. But anything around, so BFSI is one of the sectors that is core to our Indian players, right? So how is that sector moving out, and any specific region-specific insights that you can share with us in specifically related to the deals, and in this quarter, how do you see that happening?
Uh,
So
so, uh, yeah, so again, as we highlighted, banking, especially in the US, continues to be soft, driven by the base, give what we saw substantial acceleration in spending post-COVID. So base is one of the reasons. The second reason is also the fact that generally, they were the early adopters, or, the earliest to take a decision immediately post-COVID. So, a lot of spends got pulled forward in terms of trying on the digital or the front end side. So I guess banking in US is, what we hear continues to be a little soft. High tech as a space in general, again, prime also because of COVID. So if you remember, a lot of PC shipments kind of got accelerated post-COVID, which are now kind of going back to, pre-COVID levels. So there is a little bit of inventory correction, inventory write-off. So gross margins are under pressure, and that is one of the reasons that the entire high-tech value chain is a little cautious from a spending perspective. Obviously, recently, Micron, which reported earnings last week, they said that they are probably at the bottoming of that inventory correction cycle. Basically, they are so that could be some early signs of or early green shoots. Coming to the other spaces, as we said, automotive, aerospace, defense, healthcare, life sciences, continues to see good traction. The engagements continue, which was started. There are incremental spends that are aligned, in those respective, verticals. From a geography standpoint, given the fact that banking, is soft, obviously North America, we expect to have a muted performance. Europe, as I said, as we have been saying, that there are, large deals, which have been in the offing for, I think, few months, and some closures there could mean that, that could be a surprise from a deal perspective across geographies and verticals.
Continuing with the same conversation, we know that clients' interest is moving from digital and cloud transformation to, now you also said that, cost efficiency and automation. So any insight on related to the technology budgets, specifically in the discretionary projects for this quarter, or, for FY24? Do you have any color around that you can add to this?
So again, discretionary budgets saw significant acceleration post-COVID, and in terms of migrating workloads or user experience, so on and so forth. Obviously, given the fact that the rising interest rates and moderation in the demand from the user industries means that the gross margins of many of the user industries are under pressure, and that is why, which in turn is driving this shift towards cost takeout, cost efficiency deals versus significant transformations, that transformative engagements that were in the limelight post COVID. So I think this trend will continue, at least in the foreseeable future, meaning 1 or 2 quarters out. Generally, given the fact that we are already through with the first 6 months of this calendar, and December being a generally a quarter where people don't kind of go into large transformative engagements for the calendar year or for fiscal. I think this trend will continue. January will be a good time to, I think, revisit
Yes, yes.
whether this, what could be the story for calendar 24.
Yes, great. Now, just moving into a different kind of topic that's more related to strategic. So, in the few recent few days, we have witnessed some specific acquisitions that have made headlines. Either these have been either to garner niche skills, specifically, the Gen AI is now something which everybody is very interested in and trying to understand how that will pan out. Or also, some of the acquisitions have also been in terms of expanding to newer geographies. So, is there any insights on the same related to acquisitions and what companies are strategically trying to build on for the next few quarters?
Right. So, you mentioned Gen AI, and, again, I'll kind of go back to the Micron commentary. So, what they were saying is that they are seeing a higher than expected industry demand for memory and storage for AI servers. And the reason is that, AI servers have 6 to 8x more, DRAM content than a regular server. Gen AI is something is which is seeing very good traction.
Hmm.
Most of the IT companies in their fiscal 23 annual reports have highlighted either setting up of a BU or an offering on the on the Gen AI side.
Yeah.
So I think Gen AI may not be a contributor to revenue today, but I think over the next 3 to 5 years, there is a that the contribution of that offering could increase materially. So that's our view at the moment.
Yeah, yeah, and just again tying up with the same thing. So there is Gen AI, and there are certain technologies like cloud, which is something which is actually the infrastructure to build all this. So, what is the effect that you see on deals, hiring, all the metrics that we talk about? Costs, pricing, and this particularly with respect to the technology segments that we cater to, IT services, BPM, in your assessment, which could be the most affected by these technologies? And I'm talking more in terms of positively and negatively. Anything that during your conversations with leaders have they pointed out in terms of investments that they are putting into these technologies, and that same tying up with the acquisitions that they are trying to build these
Right.
technology, yeah, skills
Right.
actually.
Right. So, based on our industry interactions to date, what we understand that, the AI disruption is for real. Obviously, the vendor ecosystem, some of the product companies are not yet have thought through exactly in terms of, the changes, but definitely it is for real. And the impact of that on services companies from a services industry standpoint could be much faster this time. Obviously, we have heard about Gen AI. Obviously, the specifically can have a greater or deeper impact impact in the on the BPM side. We know automation. We have already heard use cases from an automation standpoint in terms of what can be automated from a process standpoint. I think the use cases of Gen AI can be there in that vertical. Obviously, we don't believe that there is a negative impact or from a standpoint of revenue going away. Technology historically has created new avenues of revenue streams once the newer technology adoption accelerates or gets industrialized. So our belief is that yes, there could be that transitory phase where you could have processes getting automated, or the codes being written through the Gen AI models. But over a longer time horizon, we believe that that could create incremental revenue streams for all the techs, in the entire value chain.
Great, great. And also companies we know are trying to build the skill sets, required for doing. Agree completely. Now, just going to my last question is around the outlook for the industry in FY24. What do you see the guidance or outlooks? Many companies I know have stopped giving that, but according to you, when once this noise around the macro inflation, all that is behind us, do you see growth rates for FY24 accelerating back to the double digits which we had in FY22, or what guidance can also be expected for margins during the year? And we also spoke about the deal activity. Anything, any take on, the effect of cost optimization deals on these smaller players, and also whether the digital component in deals, are they growing? Is it being tracked? How do you look at assess those, the digital components?
Right. So multiple questions. Just remind me if I miss anything. But from a 24 perspective, I think our assessment is that the for the larger peers, there could be some softness in the growth rates for second quarter also, and generally December and or 2H is not a time where people kind of ramp up. Historically, to is not a great time to kind of accelerate or newer projects or something like that. So what we think is that FY24 could remain soft, based. This is our current assessment, and for the mid tiers, obviously their growth rates are a few percentage points higher than the tier ones, and that may continue. Meaningful acceleration in 2H is a rare phenomenon. So I think so we'll kind of reserve our comment at the moment. Coming back to margins, I think and to be very fair, giving guidance in the current environment is a very tough.
Yeah,
It's a tough thing, because things are very fast. Even client decisions for projects sometimes are very quick. For sometimes they take meaningful time to kind of conclude the even the discussions or start the ramp ups. So I think that's on revenue. On margins, we believe that the margins have bottomed out, and from here on, given that companies are focusing on rationalizing the bench, kind of correcting the pyramid, there could be some gross margin tailwinds which can come through. Companies are the days post COVID of substantial wage hikes and paying out substantial hikes to retain employees are also behind. So net we feel that cost focused is cost remains the number one focus for many of the IT services companies, and the overall cost of delivery will keep on adjusting lower with all the steps in place. And that would mean that there could be some gross margin levers for companies. Pricing obviously remains a little bit of a headwind. Investing upfront investments in some of the large mega deals that can come through will be the other headwind. Obviously sales and marketing investments and the investments to kind of transition large deals are the headwinds on the EBIT line item. So that's about on the margin side. Your last question was about vendor consolidation and the impact on mid caps. If I heard that, if I understood that correctly. So I think that thesis, I think this time as of now has not played on. I think everybody's curious to understand. Historically, such environments have played favorably for the tier one or the larger players. But at the moment, based on the earnings till now, what we see is that mid caps have or mid caps or larger mid caps have been able to defend their wallet share in their clients relatively better in this cycle.
Yeah, and anything when you track things around the digital component in deals growing, does is that something that you look at, or
So
it's all
I
interweaved? Huh.
Yeah, right now I think there is a fine the lines are blurring, if I may say so. The digital component, there are few companies who highlight that percentages. One
Yeah,
among them is Infi.
yeah,
But I think as you rightly pointed out, it's a little complicated with blurring lines. So to kind of segregate that growth or create a common size growth for digital and non-digital and compare that is a little complicated number to do so, or a complicated task to do so.
yeah, yeah, agree completely. So with that, I conclude my questions. But what I summarize is, the quarter is looking a bit soft, but it will be stabilizing, and we'll have to look at how FY24 looks at going forward with all the, it may not be right to give guidance and outlook like we see, like you already said, there is a change in every quarter. You see something or the other coming up. So thank you, Abhishek. This has been really insightful. I hope our viewers also find it useful. Thanks a ton. With
Thank
that,
you.
we
Thanks, Nirmala.
thanks so much. So with that, we come to the end of this session. So request you all to share your feedback with us, and also do not forget to subscribe to our YouTube channel and the community portal for more such insights and sessions. Thank you. Take care and see you in the next session. Thank you.
Thank you.